to the podcast series Creditor's Corner Legal Talk, presented by Smith Debnam Attorneys at Law, where we explore a range of legal topics impacting businesses and private individuals. So be sure to hit subscribe so you never miss an episode. My name is Landon Van Winkle, and I'm an attorney in the firm's Consumer Financial Services section. I will be your moderator today. Today's topic is current developments in student loan relief. We will be discussing the growing issue of student loans in the U.S., how those loans are treated in bankruptcy, and how recent regulatory and legislative developments may provide relief to student borrowers in the future. Before we begin, I want to note the information provided in this podcast does not and is not intended to constitute legal advice. Instead, any and all information shared is for general informational purposes only. Listeners should contact their attorney to obtain advice with respect to any particular legal matter. With that out of the way, let's now turn our attention to this podcast's topic. With me today is Garret Kirkpatrick. Garret is an attorney in the firm's Consumer Financial Services section. Good to have you today, Garret.
Thanks, Landon. I appreciate it.
So let's just jump right in, Garret. So tell me, a little bit what's happening right now, kind of in big picture in the area of student loans.
Yeah, of course. So as some of the listeners may know, some may not, there has been a pause, so to speak, on federal student loan payments since roughly the beginning of COVID, around March or April of 2020. The Trump administration had paused the federally granted student loan repayments, and that pause has been extended numerous times now. The most recent extension of that pause came just a few weeks ago by the Biden administration, and the federal student loan repayments are at this point still going to be paused through August 31st of 2022, which would mean that payments will resume sometime in September, possibly October, depending on a borrower's actual servicer and when they can get around to having the actual payments come due. However, with that pause, there has been a lot of talk in all of the different branches, of government, executive, legislative, judicial, all of it. As student loans has been a pretty hot topic. Currently, the total student loan portfolio for the United States is around $1.7 trillion and growing exponentially every single year. And most of that comes from federally backed student loans, which are serviced by various servicers throughout the nation. And one of the biggest issues that's going on right now is in 2021, 4 of the major federal loan servicers ceased servicing federal student loans at the end of this year, or at the end of last year, and then partially into this year. They're no longer going to be working with the federal government. That's maybe in Fed loan servicing, Cornerstone, and Granite State Management and Resources. And with this, with these 4 servicers pulling out, they held roughly half of the current federal student loan borrowers at almost 16.3 million borrowers were being serviced by these 4 servicers, which is a huge impact in the student loan world right now, because new servicers are having to come in, balances and accounts are being transferred to new servicers. And so there's a lot of uncertainty when it comes to the actual borrower side of things, with these current students, or students who had just graduated, or even people who have been in the workforce. They don't really know what's going on with their loans, when student loans are going to come back into repayment. It seems like a never-ending cycle of payments are going to resume, and then at the last second they get pushed out again. And so there's a lot of uncertainty right now with these student loans. And it's kind of creating a big storm of debt in the United States that seems will not be paid back. And, there's a lot of people that are wondering what's going to happen next with all of these borrowers coming back into repayment in the next few months, especially when it comes to, the rise in inflation, the rise in gas prices, and there's just a lot of uncertainty forming around this student loan bubble and whether it's going to burst. And so I think it's just a very interesting topic right now.
Sure. So tell me, what's special about student loans? I mean, how are they different? Americans love to borrow, and we probably are one of the most indebted countries in the world. And so, one approach might be to say, well, student loans are just another form of the debt that Americans carry. So what's special about student loans as compared to other types of household debt, for example?
Yeah, of course. So one of the main differences between student loan debt and many of the other forms of debt that consumers carry, such as mortgages, credit card debts, just normal home equity loans, things like that, is that student loans are unsecured. The government and private lenders are providing these loans, small amounts all the way up to hundreds of thousands of dollars, pretty much with the idea that these students are going to be able to get into the workforce and pay all of these loans back. So the only security is the hope of a future job and future income to be able to pay back these loans. And, these are 18, 19, 20-year-olds that are taking out these loans, and they're not really certain if they even want to continue with school. They don't know what they're going to do with their job. And so there's a lot of uncertainty when it comes to whether or not these loans are even going to be able to be paid back. And like I said, they're unsecured. There's nothing backing these loans other than the promise of future repayment. Whereas obviously when, you take out a mortgage, you have the actual real property that is securing that mortgage, and the banks have some sort of security in the fact that they are giving out this loan, but should a debtor default, they have something to back it up. They have something, to get back a little bit of their investment. And I think with the student loans, you are seeing more and more financial institutions giving out these loans, giving out large amounts of loans, and then students coming back and saying, well, wait a minute, I can't pay this much, or I'm never going to be able to pay off these loans. And they realize that, at a young age, they don't really have anything, frankly, that, the lender is going to be able to come get to, secure their loan afterwards. As much, as a lot of people know, the real estate market is hot right now, but a lot of young people can't afford it. So they're renting. So they don't even have real property for, a lender to attach a judgment to or anything like that should they default. And, so there's a lot of uncertainty for the financial institutions, but as well as the federal government that are just handing out these loans. And so it looks a lot different when it comes to just what is securing these loans themselves. And I think that that's going to cause an issue because we're going to have a lot of these younger people starting to kind of wake up and realize, look, there's nothing they can really do. If I stop paying, there's nothing that they can come take because I don't have a house. I don't have a lot of assets. And so, you might see some defaults starting to happen at a greater rate just because people think that, well, there's nothing else I can do. I can't pay it, but they're not going to be able to come take anything. They're not going to be able to do anything if I don't pay it. And so I think you see a different attitude also towards student loans, as compared to somebody losing their house. And so I think that there's just a big dichotomy between just the idea of what this loan is and the attitude of the people taking it out don't really understand the severity of what it looks like, 15, 20, 30 years in the future, because there are really no consequences when you take out these loans initially, and you wouldn't see those consequences until much later. And so I just think that that they're very different than the other types of debts that Americans are incurring at this current stage.
Sure. And, anytime we see or we think about big waves of consumer defaults, in our practice, that's always kind of goes hand in hand with, what we typically expect is going to be a big, concomitant flood of bankruptcy petitions. So can you speak a little bit to what's been happening with bankruptcies in the U.S. over the past few years, and kind of how the wave of defaults has affected bankruptcy filings?
Yeah, so it's actually kind of interesting. Once the pandemic started, and a lot of people in our industry kind of assumed, well, people aren't going to be able to pay their bills; they're out of work. Their mortgages are gonna start foreclosing. People aren't going to be able to pay their student loans. People aren't going to be able to pay for their car, and it was kind of the assumption that bankruptcy would just pick up exponentially because people would need a way out. Well, that's not actually what happened. And I think the main reason is that there was so many government protections put in place when COVID first started. And again, even still, like I said, I mean, the student loan payments are still being extended even further. And I think with these government protections, people have become comfortable, having these protections and not having to pay because they're not required, or because, or they're only paying one debt because some of the other ones, are paused or they're deferred or whatever. And so people have been able to stay afloat. And I think the issue is going to be, once all of these government protections subside, and once things really start to ramp up and get back to normal, you're going to see bankruptcy filings start to increase. But what's interesting is that, in 2021, Chapter 7s were down 25% when compared to 2020. Consumer Chapter 13s fell 40%, which were down 45%, which when compared with 2019, filings back in the first quarter of 2021 before the pandemic were roughly 50,000 filings per month. But now they're well below 40,000 filings per month, and that's across all chapters. And I think what we're going to see is bankruptcy trends will start to increase when the defaults on these student loans, on the mortgages, on the car loans, they're going to increase. It's inevitable. It's just, when will they increase? And I think the answer is when the government stops protecting the consumers, because frankly, right now, there are just so many protections out there, and they're coming off slowly but surely. I mean, the mortgage foreclosure moratorium came off earlier this year. There obviously are still some protections here and there, depending on the type of mortgage that you have and who it's with, and some small nuances here and there. But you're going to start to see that the government is, frankly, they're going to want their money. And they can only hold off for so long. But that's, frankly, I thought that the payments for student loans were going to come back in, and I thought there's no way that they will extend them again past May. I mean, they had even said that the January of 2022 extension was the last one. There would be no more. And then they said, one more, that's it. And well, now they've extended it again. And so I think that it's almost pushing off the inevitable that there will be a wave of defaults. There will be people that have not been preparing for these debts. There have been people who are not thinking about these debts, or have not been financially planning on how they're going to manage their mortgage, their car, student loans, any other credit card debts that they have, once everything kind of comes back in and banks and financial institutions and the federal government is all ready to go back into seeking their payments. And so I think what we're going to see is bankruptcies will really start to pick up But I think the defining moment for that will be once these protections are no more, you know?
Sure. And I guess that, kind of brings up the next question. Assuming we get to the wave of bankruptcies, if I'm a borrower and I've got student loans, what benefit am I going to get from a bankruptcy? Can I discharge my student loans and then basically get out of jail free, or am I going to have some type of process I got to go through, or is it just I can't discharge them? A lot of people think that you can't discharge student loans. So it's also a little bit about the background there, kind of what the process is.
Yeah, absolutely. So student loans are dischargeable in bankruptcy, but only under certain circumstances. A lot of people think that they are impossible to discharge or that you cannot discharge them because the legal test to discharge student loans is so difficult to meet. So it's almost had a stigma, perpetuated over the last decade that student loans can't be discharged in bankruptcy. There's no way, which, to be quite frank, is pretty much the case. However, under the bankruptcy code in section 523A8, it accepts any qualified student loans from discharge unless the repayment of that loan would impose an undue hardship on the debtor and the debtor's dependents. And the majority rule for what constitutes an undue hardship, because that right there, those two words are the most significant part of this test, and that what constitutes an undue hardship comes from the Second Circuit under what is called the Brunner test. And this test is widely known, is followed by 9 circuits, including the Third Circuit through the Seventh Circuit, the Ninth through the 11th Circuit. And that test pretty much lays out exactly what a debtor needs to prove in order to show that they have an undue hardship. And that test is that the debtor cannot maintain, based on their current income and expenses, a minimal standard of living for themselves and their dependents if they're forced to repay the loans. Second, that there are additional circumstances that exist that the state of affairs currently, with their life and everything that's going on, exists that it's likely to persist for a significant portion of the repayment period of that student loan, and that the debtor has made good faith efforts to repay those loans. So those 3 prongs, if you will, make up the undue hardship test. And like I said, they're very hard to meet because it's a totality of the circumstances test for the most part. And they're looking at everything in your life as a debtor. They're looking at your finances. They're looking at how you spend your money. They're looking at, have you made any effort to repay these loans? They're looking at, have you, sought out every single opportunity, every reasonable opportunity to find a job, to get better employment, to make more money, to save money. They're looking at everything. And when the court does that, they're going to try and find ways to show that you have opportunities out there that you haven't tried to utilize. Again, because, and I think this comes back to the difference between student loans and all other types of debt is, if there was no protections for these student loans, you would have students that would kind of wise up and they would take out these loans. And if they could just discharge them like any other debt, they would take out these loans, go to school, file for bankruptcy. And now they essentially, with obviously the consequences that come with bankruptcy, but they would kind of get out scot-free. They would be able to get a free tuition, discharge these loans, and get out. This would be detrimental to the college tuition, student loan industry exponentially. I mean, this would lead to, underwriting issues with these loans. This would lead to, lenders being a lot more stingy on how they gave out these loans. They would require various, multiple co-signers, and, it would become very hard to actually get a student loan if there was no protection of these loans. And so the judicial system has pretty much made, and legislative through the bankruptcy code has pretty much made a way to protect these lenders and the federal government from students being able to discharge. And that's why there is kind of this stigma that it is impossible to discharge student loans because this test is so hard to meet. And it has been perpetuated, over the last decade of, more and more cases coming out pretty much saying, nope, student loans, you can't discharge unless you've exhausted every single option, unless you've tried everything to be able to discharge these or to be able to, get a better job, look for more ways to make an income. You've actually tried every single way to make a good faith effort to repay those loans. And, the federal government takes, a lot of steps to be able to help you repay those loans, including all different types of repayment options. And by, having those repayment options, again, it makes it even harder to discharge them, because if you haven't shown that you've at least tried to take advantage and have gotten denied or can't even fulfill your obligations under all of these different repayment options, they're not going to be discharged. And so I think it's just, the test is just so hard to meet that it's kind of created this sense of student loans are impossible to discharge in bankruptcy.
And to your point about, if we just let everybody discharge them, then nobody's going to want to lend, which I think is, it's a good point. And I think some critics of the current status of student lending in this country have argued that it is too easy to obtain student loans. There's very little in the way of verification. I don't really want to talk about that, but I'm curious to know, do you think it's ever going to be easier to discharge student loans in bankruptcy?
I do. Frankly, I do think that with this student loan bubble and the inevitable wave of defaults that will be coming over the next 3 to 5 years, I think we're going to start seeing the judicial developments that may loosen the Brunner test just slightly. Or if anything, they will maybe not loosen the test, but there might be just a shift in mindset in some of the judges, the attorneys, the people litigating these cases, and listening to these cases. And I think whether or not it comes out of actual policy change, I think a mindset change on student loans and how expensive college tuition is becoming and how large these student loans are becoming and the amount of defaults that are going to occur, I think we're going to start seeing a little bit of a shift. And we've already actually begun to see that on just a small level in the Second Circuit, where the Brunner test had initially come out of. There have been a few cases that have gone back and forth, and you're seeing this, you're almost seeing this two-sided argument around student loans in the judicial sense, just as you are in the executive sense. Everybody knows that there's two sides of this argument about student loans, and there's going to be opinions one way or the other, whether or not, student loans are a good thing, forgiveness is a good thing, and all those. But you're also seeing two sides of this argument in the judiciary as well. And in a 2020 case, Rosenberg versus New York State Higher Education Services Corporation, you had in that case a court that came out and said that the Brunner test is a quasi-standard of mythic proportions, and that all of the cases that came after it have pretty much perpetuated a higher burden on the debtors than the original Brunner test had ever intended. And that the court said that a court should not be looking at the efforts that a debtor should be making after they filed their petition for bankruptcy, but only the things that led up pre-petition. It doesn't matter things that are happening afterwards, and things that could happen in the future and jobs that you could get, but just what is the circumstances that led to that bankruptcy. And so, whereas normally the courts were kind of looking at a debtor's entire life and picking apart everything pre-petition, things that could happen post-petition, this court kind of limited that to pre-petition. They were looking at the debtor's good faith actions to repay a loan pre-petition only. Now, it is important to note that this case was reversed and remanded. However, that was just on the grounds that the court, neither side, did enough of a fact-intensive analysis of the debtor's circumstances that should have taken place. Like I had said earlier, this is a very fact-intensive analysis of the debtor's entire financial situation. And in this case, neither side really looked into those facts quite deep enough. And it was remanded, but not based on the law or the reasoning that the court gave for their decision at the end when they discharged the loans, but more on the side of they just wanted to review it with some additional facts that weren't brought to light in the first case. However, you're seeing also from the Second Circuit a year later in Tingling versus Education Credit Management Corporation, you're seeing the same circuit, different judge, reaffirming the undue hardship test and the Brunner test and saying that it has not become too high of a burden. And they're disagreeing with a judge in their same circuit and saying, even though the attorneys made the exact same arguments that the attorney did in the Rosenberg case, the judge disagreed, said, we're going to follow the progeny of the Brunner test and all the cases that followed, and pretty much reaffirmed that all over again. And I think that right there is kind of a good look at what is happening in the judicial concept or context, in that you are going to have these two sides going on, but I think we will start to see a little bit of a shift. I think we're going to start to see a lot more student loan cases coming before bankruptcy judges. And because we're going to have more cases, there's more opportunity for judges to make a different ruling than in the past. There's more opportunity for new law to develop, for new arguments to develop. Whereas before, student loans, of course, were always trying to be discharged, but I think we're going to see debtors attempt to discharge student loans at a much higher rate, which could create some very interesting case law in the next few years, depending on the perception of student loans and the state of the economy, and just how attorneys and judges begin to view student loans as compared to other debts like mortgages, credit cards, health debt, and things like that. So I think we're seeing this dichotomy between even within the same court right now, but I think the view of judges and attorneys might start to shift should these bankruptcies really pick up with the student loan defaults.
So we've kind of gone over some of the legal developments, some of the cases. Are there any, administrative or regulatory developments that you're seeing that may, affect the student loan situation moving forward?
Yeah. So right now, we're seeing obviously a lot of hands-on action with the federal government with these student loans, because again, the federal backed student loans have again been paused, and students or former students are pushing the federal government to make legislative and administrative changes. However, I think one thing that's really interesting in the administrative developments is that we're seeing the Department of Education recently had two controversies regarding student loan forgiveness, like we had just discussed. In discharge cases, many times they are federal student loans, and the Department of Education actually, through the Department of Justice, tried to appeal two student loan discharge cases. And it was really interesting because there was so much public outcry because they were pretty much going after these students or these former students who, again, got their loans discharged. But there were so many people saying, why is the Department of Education trying so hard to force these borrowers who have already been found to be, in one of the worst financial situations that they can, to even be able to discharge a student loan means you're not in a good financial situation. Yet the Department of Education is trying to pursue this further to appeal it, and they want their money. Well, they withdrew both appeals, which was really interesting. You don't see that very often, that an appeal will be withdrawn based purely on, the public's perception of how it looks. And so I thought that was really interesting. And I think the other thing that we're going to see is the current and new director of the CFPB, Rohit Chopra, was the former student loan ombudsman for the CFPB. And he has been very vocal about student loans and student loan debt, and has stated, when he has written testimony of the FTC as the FTC commissioner, that during his time at the CFPB, that they published widely cited reports detailing the devastating impact on student loan debt, and pursued aggressively enforcement against companies in the student loan industry that were breaking laws. And so I think you have someone at the head of the CFPB that's going to watch over this issue very closely. And I think with the right people in certain administrative positions, you're going to see some cracking down on student loan servicers. There's always been lawsuits out there against student loan servicers about lack of communication, about not being able to provide, accurate information when it came to debt transfers. And so I think you're going to see the CFPB is going to crack down, especially with Rohit Chopra at the helm of that, at that administration. And so I think it'll be very interesting to see how the CFPB handles a lot of these student loan complaints, because again, as these students come back into repayment, I think we're going to start to see a lot more complaints, obviously, because they're going to be dealing closely with their servicer. The past 2 years, they haven't had to really think about this. They haven't had to talk with their servicer. They haven't had to go online to look at anything, other than, again, when they think their loans are going to be repaid, they might go on real quick and then they see, oh, they've been extended again. But I think we're going to see a lot more complaints come in from the borrowers, especially with all of the account transfers between all of the former and the new servicers that are coming in and going out. And so I think we're going to see a lot of regulation and enforcement coming from the CFPB, which could be very interesting to see how aggressive they are with that enforcement on these servicers as well as the lenders.
So is there any, legislation or any proposed legislation that might, give borrowers some relief or change the way student loans are treated in bankruptcy moving forward?
Yeah, there's a decent amount actually of student loan legislation going on right now. Most of the bills have just been referred to committees. There hasn't been any action on any of the bills yet. As many people know, it takes a long time to get things moving through Congress. But there have been a few interesting ones that I just wanted to kind of hit on. Most of these, again, came out of 2020, later in 2021. But one is the Student Loan Borrower Safety Net Act. And this would require the Secretary of Education to create an outreach program to borrowers entering repayment after the pause. And this program would start at least 60 days prior to the restart of payments and includes reach out attempts and pretty much more communication between the servicer and the borrower, and being able to inform them of different plans like the income-driven repayment plan and things like that. So I think that one is definitely centered around communication and making sure borrowers know their options. Another one is the Student Loan Refinancing Act, which allows federal borrowers to refinance their federal student loans when the interest rates are reduced like they are currently, although again, they are probably going to go up soon, but this would, allow a borrower to refinance their student loan, which is not possible unless you go from a federally backed loan into a private loan. However, again, removing a federal loan into a private loan through refinancing would remove all of the protections and all of the different repayment plans that come with having a federally backed student loan. And so that's obviously not advantageous to most borrowers. Most borrowers want to keep their loans in the federal program because of the protections and because of the, possibility of forgiveness or anything like that would come with federal student loans. So this would allow borrowers to refinance a federal student loan, which is not possible at the current time. The one that's most interesting to me, and I think is one that might have the longest legs right now, is the Fresh Start Through Bankruptcy Act. This is a bipartisan bill aimed at the struggling borrowers to seek bankruptcy discharge of their federal student loans after a waiting period of 10 years after the first loan payment comes due. Now, again, they can currently seek discharge of their federal student loans. However, the difference would be in this bill that they would not have to prove the undue hardship test after 10 years. You could just seek the discharge of the loans after a waiting period of 10 years and making your payments. I believe you would have to make all your payments. You cannot miss a payment. And it would still retain the existing undue hardship discharge option for private student loans and federal student loans in the first 10 years. However, after 10 years of payments, it would provide a borrower an option to discharge. Now, again, you would still have to go through the normal Chapter 7 or 13 or whatever to be able to figure out how you actually want to discharge those student loans. But you wouldn't have to prove the undue hardship test, which again makes student loans virtually impossible to discharge. But I think that one is really interesting because, again, it kind of strikes that middle ground between still protecting the federal government and the private lenders, because students can't just come straight out of school or college or grad school and just discharge their loans immediately. They have to make payments for 10 years. So it would guarantee at least 10 years of payments. However, again, whether or not that goes through could be a while. it could get stuck somewhere in the legislative process. But I think that one is one of the most interesting ones because, again, it still provides protection to the actual lenders, but it's providing at least a little bit of relief for the borrowers, again, with the consequences that come with bankruptcy, but that would have to be waived by the borrower. So I think that's a very interesting one that I'm going to keep my eye on for sure to see if that one actually makes it through. But we're definitely seeing a lot of legislative developments around student loans. It's a hot topic all around the United States, and certainly in the national news, it's talked about all the time with forgiveness, not forgiveness, no forgiveness, extending the payments versus not extending the payments. And so I think it'll be really interesting to see what legislative developments come out over the next couple of years that may change the way the student loans are handled, or the options that students have when it comes to being able to repay them and go on and live their life, without this large debt hanging over their head.
Excellent. Well, thank you for this is very, very informative. I want to thank the audience for listening. Thank you, Garret, for this information. Is there do you have an email address or a phone number that any of our listeners can reach out to you if they have questions or they want to follow up on anything we've covered?
Yeah, absolutely. My email is Kirkpatrick, KIRKPATRICK at SmithDebnamLaw.com. They're more than happy to reach out and let me know if they have any questions for sure.
All right. Well, thank you again for your time, and thank the audience for participating. Don't forget to subscribe and stay well, and we hope you'll be listening to another podcast of ours soon.
Awesome. Thanks so much, Landon.
Thank you.